Hello, I'm Dr. Megan Walters. I'm Head of Research, Asia Pacific Capital Markets for Jones Lang LaSalle, based in Singapore. In our latest edition of The Private Investor, we look at the effects of currency on international real estate investments. Cross-border investment as a means of geographic diversification is on the rise. So how does currency affect real estate investment returns? Economic demand for real estate and GDP growth has tended to synchronise following the global financial crisis, and we've seen a convergence of yields in core office markets in global gateway cities. This means investors could consider the strength of the currency in a foreign location as a differentiator and all part of the attractiveness of investing overseas. So what effect does currency have on real estate returns to investors? To work this out, first we calculated a total return on a 1-year and 5-year annualised basis in office markets across 10 major cities in Asia Pacific. In other words, what would a local investor get? Then, using US dollars, UK pounds, Japanese yen, euros, Australian and Singapore dollars, we compared what an international investor would get back after investing and exiting an office investment after a 1-year and again after a 5-year period. For example, if you're an investor from the UK buying in the Sydney office market, what return do you get at the end of 5 years as compared to the local Australian investor? The answer is a local investor over a 5-year period would get an annualised 6% return on a total returns basis. On the same basis, a UK pound investor into the Sydney office market would have got 16%, whereas a Japanese yen investor into Sydney would have got 3%. The difference between the local and the foreign investor returns is due to the exchange movements between the currencies over the 5 years. We also included the Chinese renminbi to see what China investors would have received if they had been investing cross-border 5 years ago. We've also done a forward-looking estimate for returns to investors in 2012 using our Jones Lang LaSalle forecasts combined with foreign currency forecasts from IHS Global Insight. Who will do best in 2012? Well, Beijing is top for returns in most currencies. Plus, there are some interesting features, such as Singapore dollar investors into Australia, who look like they might do well as compared to other international investors. For the big picture and all the details on the 7 currencies and the 10 cities, do have a read of our new report.